let's get down to business. Tonight we're here to learn from a straight shooter, a financier to startups, and an all-around great guy. Over the years, Matt McDonnell has helped advise startups to find the right financing to become successful. At his current role at Notley Ventures, he's taken aim to help startups get wins and focus on the art of fundraising. Tonight, he's going to take us on the journey of how to prepare for funding. So, ladies and gentlemen, let's welcome Matt McDonnell.
Is this good?
Yeah, I think that's good too.
All right. Can everybody hear me all right? Awesome. Great. So thank you, Team Austin. Thanks a lot, Reza. It's really awesome to be here. I've watched Team Austin grow over the last couple of months. It's super exciting about the 501c3 being finally granted. And it's just a really nice opportunity to see a lot of people in the tech community who care about doing good and giving back. And I'm going to talk a little bit about why that resonates with me so much in particular. So tonight we're here to talk about fundraising. This is something that people talk a lot about, and before we get going, you can find more opinions than you could possibly care to consume online about how to fundraise. So my goal here is pretty simple. I'm going to try and convince you not to fundraise. And if I'm not successful, then I'm also going to try and convince you that there are options out there besides priced equity rounds from VCs. I think if you look at the way that the fundraising market is moving, it is like many, many things in our world right now. It's towards an increasing level of diversity, and there's a proliferation of options. And so my real goal tonight is to talk about a couple different options to highlight some of the potential problems that you could run into when fundraising, and then to really give some practical advice. So you'll see on some of my slides, I'll reference a couple resources. There are probably about 3 or 4 in here. I strongly recommend that when we highlight those and when I mention them, I have found them to be the most helpful and useful resources, and it's really interesting when you meet an entrepreneur who's used them, you can tell. They're genuinely well prepared. So I'm a partner at Notley Ventures. We have a very core belief, which is the following. Businesses should behave more like nonprofits from a mission perspective, and nonprofits should behave more like businesses when it comes to their operations. That's it. It's pretty simple. We often get called impact investors. We hear this term thrown out a lot, and I really don't like it. I don't like it because I believe that if a business is successful, it's going to have an impact, and it's up to the entrepreneur to decide what that is. So with that caveat and understanding that we come at things just a little bit differently than you might hear from a traditional VC or a private equity firm, I'm going to tell you why you shouldn't raise money. So the first thing about fundraising, and I'll come back to this point a lot, there is an enormous opportunity cost to fundraising. One of the things that you should be aware of is that roughly 0.5% or so of all businesses started in the United States raise VC financing. Just less than 0.5%. Now it accounts for roughly 25% of the GDP of our country, so it certainly has an outsized impact. But just like you would think long and hard before you applied to Harvard or Stanford as an undergrad, you should think long and hard whether or not you're willing to make the commitment to go after VC funding. It's also not appropriate for all types of businesses. We're going to talk in just a minute about the sorts of businesses that really make sense for VC financing. But in general, your default rule should be VC funding is not appropriate for your business unless you meet certain qualifications. The other thing about VC fundraising that very, very few people really, I think, take seriously is that it really limits your optionality. So what I mean by that is, as you go down the fundraising path and you make a commitment, you take investment dollars, there are a whole lot of avenues that are closed off to you. There are lots of business opportunities that you can no longer pursue because you've made a commitment to your partners in the business, the folks that have provided you the capital, to pursue certain outcomes. So you may very well, and I would say that this is almost always the case, find yourself in a position where you've raised money and you have an opportunity that you can no longer go after, even though it might provide an appealing or attractive return. It took me years to start watching Silicon Valley because it was just way too close to home. But there's this amazing moment in season 2 where Pied Piper meets this other entrepreneur and he says, hey, look, I got this amazing valuation. It was, whatever it happened to be, $10, $20 million. And then I couldn't make this business worth $1 billion, so they took my company away. And so when we talk about optionality, or we talk about the potential future misalignment of goals, this is a very real thing. And the trouble is you need to do all of this thinking up front. You need to essentially be a fortune teller about your future and make decisions within certain broad guidelines. But you're going to bear those consequences 3, 4, 7 years into the future. So it's very important, and I want to impress upon everybody that the time to think about what those outcomes look like is before you ever put together a pitch deck and before you ever raise your first dollar. It's also expensive, right? So fundraising is expensive in terms of legal fees, but I think more importantly, and we'll talk about this more in detail, it's a huge opportunity cost. It becomes your full-time job. So it's not just dollars, it's all of the other things that you could have been doing were you not pursuing fundraising. And finally, and I think that this doesn't get paid quite enough attention to, although you read about it, is this issue of loss of control. So today, if you start a company, it is your company. You have no partners. You don't have a responsibility to anybody other than the customers that you make a commitment to and to anybody else that happens to be on your team. Take it very seriously when you take VC fundraising, when you take that financing round, because you will lose control, but you will also have long-term partners. And so there is an upside and there is a downside. And I think that's what's so challenging about fundraising, is that there are no simple answers. It's an awfully complex situation. So, given the fact that it costs a lot of money, it takes an enormous amount of time, you could be doing a lot of other things, and you're going to lose decision-making ability over your own company, the thing that you've worked so hard to start. I want to caution you, and I just want to say again, don't do it if it's not absolutely the right path forward for you. So why should you raise money? There are a bunch of reasons that you should raise money. This is one of those areas where I want to call out a couple different resources. I'll actually do that in just a moment. So here's why you should raise money. You're working on an exponential technology. So what do I mean by an exponential technology? You hear VCs talk about growth a lot, right? So the way I look at it, there are essentially two different kinds of growth. There's linear growth. So think of a consulting agency. You hire one guy, you make a couple extra $100 a week. You hire a second guy, you double that. You hire a third person, you triple it. That's linear growth. The more you do, the more money you make. Exponential growth is an entirely different beast. We all know many examples of this. We're sitting in Google Fiber. There's probably not a better example. There's another organization, it's called the Day of Code. So the Day of Code was started as a nonprofit organization, and the whole intention was to get people, as many people as possible, exposed to development. The Day of Code got to 1 billion users faster than anybody else ever, faster than Twitter, faster than Facebook. It was clearly exponential growth, right? It was doubling at an accelerating rate. So if that's the kind of company that you're interested in starting, or that's the kind of company that you have started, VC financing might very well be appropriate to you. Your product also has to be scalable, right? So go back to that consulting analogy. You can't scale people's time, but you can scale a product. This third point, I think, is particularly important. The core reason that you would raise a round of financing from a venture capitalist is time. It will get you to the market faster, it will shorten your research and development cycle, or it would take you way too long to do some of the things that you know you need to do by yourself. So I'll give you a really good example. Let's say that you're a B2B business. You build a piece of software that you want to sell to the Fortune 1000, but you've never worked in the Fortune 1000. It might be a really good idea. You have a scalable business, right? It's exponential technology, but you don't know any of those people. You don't have those contacts. that would be a very good reason to go out and at least talk to the VC community and ask them, who can you introduce me to? I don't have the time, say 20 years, to build the relationships that you already have. It's also important from a timing perspective if you need to capture market share quickly. We recently formed an advisory agreement with a company that's on a mission to replace all of the CFL light bulbs in the United States with LED. That's an interesting technology. It's potentially exponential, but the thing that's going to make or break that business is whether or not they do it first. They're not the only people to have this idea. There aren't really very good barriers to entry that make them a defensible business. And so the reason that they approached us was an understanding that they need to move fast and they need to grab market share quickly, and they can give up margin later on when competitors enter the market. And this is perhaps the most important thing. How are you going to spend that money? So one question that you're going to get asked anytime you walk into somebody who gives capital as a profession is, how are you going to spend it? Here's an answer that's not very good. Marketing. How? What's your customer acquisition cost? Are you going to hire somebody, or are you going to hire an outside agency? Right? Those answers are average. If you were going to say something like, we've run 4 marketing tests, 1 on Google AdWords, 1 on Instagram, 1 on Facebook, and then a 3rd was an email campaign, here are our customer acquisition costs. We're raising money to go after the Facebook campaign and the Google AdWords campaign because the other 2 didn't work so well, because their customer acquisition costs were $4, and we're selling something that costs $3.99, right? That's a much better answer. And so I caution you again to be very, very specific. You're going to hear this theme come up over and over again. What are you actually going to spend that money on? Have a very, very good answer before you grab some of the baggage that we talked about in the previous slide, the huge opportunity cost, the loss of control, etc. So now we're going to talk a little bit about different kinds of fundraising. So I'm going to give you a couple of different options. And again, my mission here is to tell you about your options, but also to dissuade you from going down this path unless you have very good reasons to do so. So the elephant in the room, whenever you talk about fundraising, is a priced equity round. This is what everybody thinks about when they think about venture capital. This is the traditional VC financing. You sell shares in your company that have a certain set of rights that come with them that other people don't have available to them unless they purchase those preferred shares with capital. There's a lot of information, and here's one of the resources that I'm going to recommend. It's a book called Venture Deals. This is by far the best book that I've found that's been written about this. It is very detailed. It might take you a little bit to get to. It's well worth your time to read through the whole thing. And one of the things that they spend a lot of time talking about is this participation, liquidation preference, and dilution. So here's the good news. They don't really matter if you're a seed stage company right now. It used to be the case that you would have participation. So what that means is that, let's say you're a VC and you've purchased preferred shares, you can participate also as a common share owner. So when the company has an exit, not only do you get your return for preferred shares, but you get an additional return as a common share owner if you have participation rights. So it's very favorable to investors. It's not particularly founder friendly. And the good news is that founders build businesses, not investors. And so over time, founders have been able to advocate for this term being largely diminished, although it does come up still. You've also got the liquidation preference, right? So who gets paid first? This is something else that you can spend a lot of time thinking about and reading about in Venture Deals. I will refer you there. I don't think that's the most important term for our purposes. And then you've got dilution. Dilution is important. Again, read the book. But the thing about dilution to understand here is not the technicalities, it's not the nuance. It's that whenever you take financing, the thing that you should be thinking about isn't your current round, it's round 2 and 3 that will come subsequently. right? So dilution is, the general concept is you sell more of your company and you own a smaller portion of a bigger pie. And so the fundamental question that you need to ask yourself is, will that smaller portion be more valuable than the large portion that I have today? But here's the meat and potatoes, and I'm going to share a couple of examples with you. So there are really three terms to any equity financing. There's valuation, there's the amount of capital you need, and there's a portion of the company for sale. So I'm going to give you two different examples of how you can go about figuring this out. So let's say I decide I need $250,000. And I don't really want to sell more than, let's call it a quarter of my company. Well, bingo, my valuation is $1 million after I've raised that money, right? I've sold 25% of the company for $250,000, so my valuation is $1 million. That is a horrible way to decide what the valuation of your business is, and I see it over and over and over again. What you want to do when you decide on a valuation is you actually want to decide on a valuation. There's a reason I put that at the top of the triangle. It's the most important thing. We can spend a lot of time talking about how you would arrive at that, but at the end of the day, there are really only two methods. There's a discounted cash flow model, so you figure out, here's my model for what my revenue and my expenses will be going forward, and I'm going to provide some discount rate to those cash flows and determine the present value of my company. Then I'm going to decide how much money I ought to raise because I've decided very, very clearly, here's what I'm going to spend my money on. And then you'll know what portion of your company is for sale. You might decide that that's not something that you want to do, but that's a much better way to approach the problem. Decide on valuation first, then understand whether or not you're comfortable with the portion of your company that you would have to give away for the required capital. I could probably stand here and read this slide 10 or 15 times. I think it's so important. So again, just when you're thinking about valuation, please don't do this glib, off the shelf, here's how much my company's worth. Also, you'll hear, if you read VentureBeat or you read TechCrunch, the valuations are out of control in venture capital, right? I'm not going to wax poetic on that one way or the other. I think there's plenty of information out there. But the point is, or the sort of core issue there is that you have people coming into VC offices, or the belief of those that ascribe to the view that valuations are too high. You have people coming into those offices and saying, my company that does X is worth some astronomical amount that can't be justified. And so it's the justification of your company's valuation that you really want to think long and hard about. That is not a number that you come up with when you're putting together a slide deck. That is a number that you come up with potentially working with your CPA, but that you definitely come up with working on an Excel spreadsheet. So that's equity financing. We'll get into the details in a minute, but point is, think very carefully about your valuation. Another option that you have that people talk a lot about, that you've heard a lot about, is convertible debt. So a couple of years ago, I don't remember the exact year, but sort of call it 2008, 2009, Y Combinator, who's listed as the reference here, put out documents on their website. And the documents were, here's a free downloadable template for convertible debt. I'm going to talk about another fundraising model that Y Combinator is using, but the point is this. As soon as Y Combinator put those documents up for free, everybody started using them. And all of a sudden, there were convertible debt deals all over the place. They were the most fashionable kid in school. Everybody wanted to use convertible debt because the conventional logic was that, look, there are a lot of real good benefits to convertible debt. This is, just in full disclosure, this is the slide I could spend the most time on. Convertible debt is one of those things that we're just starting to learn about because it's been out there in the wild for 10 years, right? The trouble with the new and innovative financing is that nobody actually knows what that's going to look like 10 years down the road. And so I want to sound a word of caution, especially as I start to talk about these new models, that until you know what those outcomes look like, until there's a lot of data, you don't really know whether or not that's the right fundraising mechanism or the right structure for you. So here's what's interesting about convertible debt. You don't have to price your round. You don't have to decide on a valuation. So remember this triangle, right? That's the hard part here. That's the difficult thing. And oftentimes, it's very early in your company's life cycle. You can't do a discounted cash flow model because you don't have cash flow. You don't have revenue if you're building a product, or maybe you're just not profitable. You've got a little bit of revenue, but whether or not you do a liquidation valuation or a discounted cash flow valuation, it looks like you're worth nothing. That's clearly not the case. And so that's a really good time to use convertible debt because you don't want to put a price on your round. You want to see how things go. And so there's some interesting terms that you need to think about when you raise convertible debt. So there's the maturity date. I like to call this the time bomb. So the way the convertible debt works is you issue a note and you say to somebody, I will pay you back at an agreed upon interest rate at this date in the future. Unless somebody comes in, tells me my company is worth a whole lot more, and provides a qualified financing event. So the thing about the maturity date is that it really does work like debt. When you hit that maturity date, that note is due. And you either have to have converted those note holders into equity, right? So they purchased, call it $100,000 worth of debt, and it's going to convert into shares of the company later on, or you got to pay them back. And so think very carefully about the maturity date. This is one of those terms that I see amended over and over and over again. And it's because either people chose to use convertible debt and they should not have because that wasn't really the nature of what they were doing. Or it's because they were just wrong about the timeline, which is totally reasonable. And if there's anything I can tell you about startups, it's that no plan survives contact with the enemy or the customer. So whatever you think is the case today, that's not going to be the case 12 months from now. I don't know what it's going to look like, but I guarantee you it's not what you think it looks like. And there's a lot of risk in choosing a maturity date. There's also the interest rate. Nobody cares. The interest rate isn't that interesting unless it's huge. Don't spend a lot of time and energy on that. Hopefully it never comes into play. Then there's the discount. People do care about this. So I'll keep the math simple. If we had a 20% discount rate, you would say that for every 80 cents I loaned to you, when it converted to equity, I would get to $1 worth of those shares. So the discount rate really does matter. And when you think about the discount rate, and that's typical, 20%. When you think about that discount rate, though, and you think about that maturity date, and you think about that interest rate, I just kind of want to put this in your mind because there really is a time bomb here, right? That interest is accruing. Maybe you were wrong about your maturity date. So now that date gets pushed out further and further into the future. So more and more interest is accruing. So obviously that creates a debt problem, but more importantly, it creates an equity problem. So if you thought you sold 20% of your company on this convertible note, so again, keep it simple. You think it was worth $10 million. You raised a $2 million convertible debt round, and you keep pushing that maturity date, and that interest keeps accruing so that when those notes convert, right, you extend 12 months, you extend 18 months, because you're so close to that next deal, or you're so close to profitability, or you just need to raise a little bit more money. And all of a sudden, you find out when it converts eventually, if it converts, that you own a whole lot less of your company than you ever thought you would end up owning. So the interesting thing about convertible debt is that the problem with it is that it's debt. So there's a lot of laws about how debt works, right? You need to choose all of these terms, the maturity date, the interest rate, the discount rate. I'll come back to the cap in a second. So Y Combinator, again, constant innovators, they're innovating on their legal documents, and they said, hey, here's this thing called the SAFE. So basically what it is it's a convertible note without the debt. So you still don't have to price the round. It's really just an option for preferred stock in the future, paid for today. I have no idea whether or not the SAFE is going to be a good investment tool. My guess is it is. It's at least going to be marginally better than convertible debt. But this is one of those examples where innovation in financing could be a really good thing, or it could be a really bad thing. Anybody that tells you that they know the answer, I would be deeply suspicious of. I don't think any of us do. I don't think any of us are really going to know for 10 years. My guess with most things like this is that there's something that we're not currently thinking about that's not in the consideration set that's going to be a problem with the SAFE note. Now, whether or not that's a huge problem or just a minor issue, who knows? There's no such thing as a perfect financing vehicle. So I want to talk about the cap, because I think this is the most glibly thrown about term in a convertible note. So it's essentially your quote-unquote future valuation. So what you're saying when you raise convertible debt is that I'm going to convert your equity either at the discount, or let's say that we do really, really well, right? And we make a bunch of money, and somebody comes in, we thought our company was at a $10 million cap, and somebody comes in and offers us $12 million or $15 million as a valuation, right? The idea is that for those investors in that round, their deal's never gonna get worse than that cap valuation, right? They're always gonna do better. So from the entrepreneur's perspective, it's important to think about the cap, right? You don't wanna, quote unquote, give away your company. But also it's important to be fair. And the good news about the cap, I think a lot of people talk about it, a lot of people are concerned about it, but the good news is that when you go to market and try and raise money, people will tell you whether or not it's too high or too low. So convertible debt is kind of a strange animal, right? But there are other sources of debt out there. So this is what I would refer to as traditional debt. So there are lots of times you would want to use traditional debt. And there are some problems with it. For example, financing inventory. So you're a CPG company, you get a big order. How the heck do you keep the business afloat while buying $500,000 of inventory and paying all of your people who have lots of things to do before that product actually gets to market and gets sold? Traditional debt can be a really helpful vehicle for that. You also might want to expand an existing business. So I've seen a few people recently who have a good business, and VC priced equity rounds are the fashionable thing to do, and so they decide to go and raise equity. Well, it might be a much better idea to raise conventional debt. You also don't give away control, and that's the most important thing about debt, right? You don't give away control. Sure, there are all sorts of hooks and all sorts of pitfalls, but you don't have to give up control of your business. And there are lots of sources. So I'm going to just run through these really quickly, but I think that these are worth thinking a little bit more closely about. So Able Lending is great. Able Lending is this awesome kind of hybrid between sort of friends and family round plus debt, right? So you go out, you get some backers. Able offers you some loans. It's a private market loan. It looks a little bit different than you would traditionally see from a bank or something like that. And it's a very good way to raise some money, and it's also helpful for Able because your friends and family validated that, yeah, there's a bunch of supporters for this business. Factoring is another example. So short-term interest payments on typically purchase orders or some other guaranteed revenue, right? So there's a great group in town here called Far West. You send them your purchase order. They advance 80% of the money that you would make on the purchase order. So you have a $500,000 purchase order, you send it off, they give you $400,000 to order your inventory, and then once the product is sold, you pay them back plus interest. It's a really helpful service. It's expensive, but it's available. This is one of the most exciting things. There's a great company in town called MicroVentures, and they've recently got into the business of PO crowdfunding. Right? So let's say you come up with a new product. It's the same thing as factoring, but you don't have to go to the factoring agency. You can actually get your you can also get your purchase order crowdfunded. There's a bank. We all know how to walk into a bank, have a conversation with a loan officer. The dirty truth about most startups, though, is that they are, quote unquote, not bankable. You either don't have enough operating history, you don't have 3 years worth of financial statements, you might not have revenue, probably not profitable. So lots of reasons to kind of think twice about bank debt. You've also got small business association. The only downside to an SBA loan is you have to provide a personal guarantee. So just think very carefully. If 90% of startups fail and you go out and you ask for an SBA loan and you have to pay back that loan whether or not your startup fails, it might not be the best bet depending on the type of venture that you have. And finally, private debt. There's lots of resources out there. There's lots of folks. This is the kind of darker corners of the capital markets. People that don't necessarily advertise their services get referrals and network, but there are lots of individuals. Dallas is a real hotbed of private debt. There's lots of folks out there that will negotiate terms with you that are a little bit more flexible than banks, but at the end of the day, look a lot like bank debt. And so, just think very carefully about your business, right? Are you willing to take that personal guarantee? Does your business have the cash flows and characteristics that we've talked about that would make it appropriate for debt? So remember, I'm going to try and convince you not to raise money. And so I'm going to stop here again, and I'm going to talk about bootstrapping. So bootstrapping, essentially, you reinvest the profits of your own business back into your business for growth. You don't take outside capital. The genesis of our fund is buildasign.com, Build a Sign Now. And Build a Sign was first purchased profitable. So they designed a tool so that you could go and you could design your own sign. So let's say you were a realtor or whatever you happen to do. You'd swipe your credit card, and then a couple days later, your sign would show up at your door. That's a first purchase profitable business. If there's margin in that particular sign, the moment somebody pays you, they pay you up front before you do the work. That is a perfect candidate for bootstrapping. Services firms, we've talked about these a little bit. There is a trend that I've noticed towards VC funding of services firms. Typically, that's to support an ecosystem. We do a little bit of this ourselves, although generally speaking, unless you're pursuing hypergrowth or you have a particularly thorny problem, they're bootstrappable. Most MVPs, so even if you're thinking about raising money, and even if there's a very good reason to do it, wait as long as you can. The best thing that any entrepreneur can do in general is procrastinate fundraising. Wait as long as you can, get as far as you can before you get outside capital, before you lose your optionality, and before you give up control. And then e-commerce resellers. So this little charge cords company is one of my favorite companies around. I met the entrepreneur a couple of years ago, and he basically just had a little personal problem. He couldn't get an auxiliary cord to run from his cell phone to his car, and it was driving him crazy. So he went out, he found a producer in China, in Shenzhen, and he bought a little bit of inventory, about $100 worth, and he just did an experiment. He threw it up online, bought some AdWords, and tried to figure out how much it was, whether or not he could sell the product. Well, he could, and he's built himself a nice little business. And then there's crowdfunding. So this is the Wild West. The Jobs Act, Title III, May 31st, you are allowed to crowdfund equity, right? So this is brand new. I do not pretend to know much about this space other than we are going to crowdfund a project in the not too distant future. But traditional crowdfunding, I think, is a space that people are rather familiar with. And you want to use traditional crowdfunding essentially for two reasons. You want to test demand, or you want to validate that there is demand because you're going to go raise money. There's a SpaceX started this way. There's an interplanetary mining company that started this way, right? And so there's now they haven't done any interplanetary mining yet. He's the author of the book that's listed on these resources, but the point is there. If you want to find out if people are interested in your project, go do this. It's as much work as fundraising, but it's a little bit less risky, and you don't necessarily give up control. It's also helpful to build a community, right? And again, do your research. Crowdfunding is the most rapidly changing part of financing. It's worth taking a look. There's two more that I'm going to mention. Revenue-based financing is the new kid on the block. This is something that Notley Ventures is quite interested in. Tim Draper has an RBF fund that's operating in London right now. And basically the idea is no personal guarantee, no ownership is exchanged. You do not give up control of your company. You get investment for a percentage of your future revenues. This is a really appealing model for e-commerce companies, for consumer packaged good companies that need to finance their growth, but are doing just fine on their own. You don't need a bunch of people on your board or something like that. And again, there's no personal guarantee. There are a few people doing this in Austin. It's not kind of systematic, but if I were a betting man, I would say that in 3 to 5 years, RBF shops are going to be all over the place because they really do sort of solve a problem in the market. The last one is accelerators and incubators. So here's all I'm going to say about these guys. Accelerators and incubators are great if there's a fit, right? So think about very carefully what you're trying to achieve and whether or not that accelerator or incubator provides those things. Is it in the right location? Do they have the network? Let's say you're a great marketer and all they do is provide marketing services. Probably not the most useful place for you to go. Accelerators used to be kind of one size fits all, but the diversity of them has really popped lately. There's all sorts of people out there doing this. There's some pretenders. There's some accelerators and incubators that are really, really reputable and solid. So do your research here and figure out if there's a fit and understand the cost, right? A lot of incubators, you're gonna have to give away a large percentage of your company for a relatively small investment. So go back to that valuation triangle and figure out whether or not it's worth it for you. Great. So we've spent most of our time talking about all these fundraising options. Now, how the hell do you do it? So here's the most important thing. It's all about relationships. That is the only thing that matters. If you take nothing else away from this conversation, take just that away. If you ask for advice, you will get money. And if you ask for money, you will get advice. This is the most true statement that I could possibly utter about venture capital. An emotional investment always precedes that capital investment. And I think that the most important thing to mention here is that you can't be afraid to talk about your idea. I can't tell you how many founders I've met with who are concerned about talking about it. Well, here's the thing. Your ideas are cheap. Everybody's ideas are cheap. They don't matter, right? There were 400 other people that thought about Facebook roughly at the same time that Mark Zuckerberg thought about it. The difference was execution. And so if you're looking for a partner or you're looking for a fundraising partner who can help you make your vision a reality, they're not in the business of stealing people's ideas. Just think about that for a minute. Think about how bad that would be for business, for an investment firm, right? Very, very quickly, people would stop coming to them. Don't be afraid to talk about your ideas. You'll be astonished at how much you learn if you do talk about them. And then there are two key people that I'm going to mention in terms of your fundraising strategy. So one is mentors and one is advisors. The most important thing that you can do before you raise money is develop these relationships. So mentors are people that believe in you, right? They're not going to care whether or not, generally speaking, you succeed this time around. They see some sort of long-term value in you as a person, as an entrepreneur. They don't come along very often, right? When you talk about mentors, right, if you were to have a conversation with somebody and they were to talk about their 12 or 15 mentors, right, they're not talking about mentors. This is a small group of people you trust implicitly, you think can provide a lot of value, and most importantly, they will open up their network to you. They'll stick your neck out to help yourselves. And then you have advisors. So the big difference with advisors, there's more of them, and they tend to solve specific problems. So you might have an advisor who's really, really good with HR, and that you want to go to every time you have a difficult HR situation, or you have to have a hard conversation that maybe you haven't had before. So between the mentors and advisors, right, remember, raising capital is all about relationships. This is about scaling your relationships. So if you can have 20 important relationships that give you access to 100 or 200 other relationships, that's really, really important. And that's about 90% of the way there to actually raising financing. I'm not going to spend a lot of time on this one. These are the materials you need to raise, right? You need to have these things. They're necessary. They're not sufficient conditions. Here's the general approach that I like when people take. And here's the other thing that I don't think a lot of people in the venture capital market will tell you. We're the only people that can be wrong more often than weathermen and still have our jobs. And so what I'm going to tell you how I like to see this done, but do not take that as gospel. Everybody's got a different opinion. Start with a one-pager. It's an executive summary. See if people are interested. Nobody wants to read a deck if they're not interested, and they won't. So send them an executive summary. If they're more interested, send them a deck. Be prepared to iterate on that thing like crazy, more than your product perhaps in that small period. And then think too about the audience, right? Are you presenting it? Are you standing here talking to people? Or are you asking them to read it? Really kind of put yourself in the shoes of the person that's reading that deck. I know that sounds obvious, but you'd be astonished at how infrequently that happens. The legal documents, here's what I'm going to say about lawyers. And I happen to have a JD. Deal structure is important. It is important to have belt or suspenders. It is not necessarily important to have belt and suspenders when you start having the conversations. You want everything buttoned up eventually, but what you don't need to do is go into your first fundraising conversation with $20,000 worth of legal documents that the first person that you talk to might say, we got to change this. Right? So have those conversations early, but don't necessarily spend a lot of money until you've gotten feedback from the people that you're raising money from. And then lastly is business materials, right? So what is an investor investing in? They're investing in your business. So don't walk into an investor meeting and not be able to send a pro forma of what the next couple of years are going to look like, your forward-looking financial statements, very shortly thereafter. And then the metrics, right? So if you're a SaaS company, there are metrics that matter. You should know your churn rate. You should know what it costs to acquire a customer, right? So think very carefully about your business and have those ready at hand. And then you're just about ready to think about who you should talk to. So if anybody has ever done enterprise sales, fundraising looks almost the same. You start with a pipeline of 200 people that you think are potential fits, and then you disqualify them until you get to 1 or 2 people that want to participate in your round. Couple tools that are easy to use and that I would recommend. Obviously, you can use Excel. Streak is a Gmail plugin that builds pipelines. It's one of the best tools around. If you haven't used it, I highly recommend it. It's free. It's the easiest way to get this process going. Pipedrive, $25 a month. Great, simple, light product. It'll help you really kind of get after this funnel in a deliberate way. And then you want to iterate, right? So let's say you build a list of 200 people. Don't send an email with a deck to those 200 people. Send it to 25. See who opens it. See what questions they have. Don't burn that list all at once. This is really a sales process more than anything. We'll go through these pieces. These are all different, right? The first meeting it's going to be different depending on who you talk to. But here's the important thing, 2 important things. Don't take your advisors, right? Investors invest in you. So don't bring people that are extraneous. Bring your core team, bring the people that the investor is supposed to believe in, because at the end of the day, as an investor, you think to yourself, if everything goes sideways, which it will, I promise, the only thing you're left with is the entrepreneur. So bring those people. And remember that this is dating. It's not a dating show, right? So in a dating show, you have a suitor, and then you have 3 people who are competing for a date with that person. It feels that way when you raise funds, but that's not actually what's happening. You as the entrepreneur have the power, right? Investors compete for the best deals. And so your job is to be the best deal, not to convince an investor that they want to fund you. That authenticity goes a very, very long way, and I think is much more likely to produce the results that you want. The other question that you have to ask yourself is whether or not you're walking into that conversation and you know what deal terms you'd like. Have you decided on your valuation? Have you prepared the documents and you're saying to people, here's the offer, here's what I'd like, provide your feedback, yes or no? Or are you going into a conversation looking for a lead investor, somebody who will help you set those terms? I think that's a real big inflection point. And in general, I've tried to focus on the commonalities here, but I think that's a very important inflection point, and does indicate a slightly different approach to that process. We've talked about how are you going to use the funds, but I'm going to say it again because I think it's really important. And then I think the other thing you need to think about is, how can that particular person provide value to your deal, right? So people have this idea in mind that investors are people that just provide capital, but I'm going to bet that most investors get into their work and into that business because they actually like to help companies grow, right? That's what they do. That's what gets them out of bed. And so how do you want that person to help you? You should be pretty darn clear about that. And they're going to play a role in the future. So you better be happy with that individual and like them and want them on your team. There's follow-up meetings. These are really, you're going to run through a certain number of them, maybe 3 to 4. The investor is really understanding your team, and they're getting to understand your business. Beware of implicit negotiation. So remember that this is all a negotiation. So it might seem like a casual conversation, but if you were to say something that was perhaps half true or not totally accurate, you might have to live with that later on down the road. So I encourage you to be very, very careful and choose your words and be clear in these conversations. And then if you're lucky, you get into diligence, right? So here's the thing about diligence. Everybody's got a different approach. Everybody's going to send you a checklist. They're going to ask for different materials. Here's what they're all going to ask for. Think of it as your company passport, your formation docs, your operating agreement, your bylaws if you're a C Corp. You want those core nuts and bolts. You want your historical financials. You want to be able to tell somebody what the next 2 years look like. And those key metrics that we've talked about. Lastly is the cap table, right? So this is really important. People are really lazy about cap tables. Use eShares or some tool like that to manage it for you. People want to know who else is on that cap table and what problems there are. Do you have a founder who, after they take this money, who's key to the business, is only going to own 2 or 3% of the company? That might be a very good reason not to invest, because you need that person to drive the business. And then finally, terms, right? So here's the thing that I want to stress. At this point, when somebody says, I'm going to invest in your company, remember that pro forma? Remember those business metrics and that model that you built? Go back and plug those terms in. If you need help, hire somebody. But understand what the implications are. So if somebody says to you, I'll invest in your convertible note at a 20% discount, 6% interest rate, $7 million cap, what does that actually mean if you hit all your metrics next year? Does that mean that you just gave away too much of your company? Reassess those term sheets and do so carefully, and go back to those mentors and advisors and have those conversations. And then finally, the closing, right? So that's easy. Sign a bunch of documents. It's like a real estate closing. You walk in, there's 200 pages of stuff. You've probably read some of it. Your lawyer's read all of it. You're pretty sure it's good. You're just going to sign on the dotted line. And that is just the beginning of the relationship. That's the wedding. Now the real work begins. You have to do what you said you were going to do, but you also have to keep your investors updated. This is the number one reason, I believe, why investors don't follow on in rounds. It's the number one reason why they lose interest in a company. Keep them updated. Send them updates. And be honest. Tell them what you're struggling with, right? You're already aligned. They're already in the boat with you. So tell them what you need help with, and they might be able to help. If you sit there and you suffer silently, not only will you lose that capital, but they also won't have the opportunity to help, and they'll be pretty cranky about the fact that you didn't come to them way before things got dire. And so finally, some parting advice. Fast turnarounds. Don't ever let anything sit for more than 12 to 18 hours. Investors are busy. If you want to invest in one company, you look at 200 of them, maybe a couple more. Stay on the radar. And lastly, these are the last 3 bullet points are kind of my rules to life, and so I'll leave you with that. Don't be dumb. It sounds pretty glib, but here's the reality of that advice. You almost never know as an entrepreneur what the hell you're supposed to do. You don't know what to do next, but you probably know what you shouldn't do. Avoid that. Just don't do that one dumb thing, and things are probably going to work out. And it sounds a little bit off the cuff, but it really is true. Don't be dumb. Ask for what you need. Ask the investors for what you need. If you need a certain option structure, if you need a new co-founder, right? Whatever you happen to need, ask for it. The worst thing that can happen is you get told no. And remember, it's not a dating show. You're not competing for attention. You're looking for a fit. And then remember, everything always takes longer than you think. So I can't tell you, I would say with 100% accuracy, people walk in, they say, hey, we're going to close this round by August 31st. And then we have another conversation in October, and they're just where they were. These things take time. Plan on it being a full-time job. And then you won't be surprised when it takes a very long time. So with that, I'm told I'm out of time, so thank you and best of luck.
So now is the fun part where everybody who has a fundraising question or anything that has to do with raising money can come up here to this microphone and ask Matt whatever's on their mind. I ask that you guys just please keep it to fundraising and not necessarily asking for money. So let's just keep it to that. All right. So you guys, if y'all want to start coming this way, if you've got questions, start filtering over here. So,
we talked a lot about disqualifying if a company was right for fundraising or not. What advice do you give to the companies that you disqualify and say, hey, you're not right for venture capital?
Yeah, that's a really good question. So that's a really good indicator of whether or not you're talking to an investor that you want to have a second conversation with. So the other thing I would say about VC financing is play the long game, right? If you're a real serial entrepreneur, you're going to go back to these people multiple times, right? And so when we say no to a company, we typically want to tell them why. And if an investor doesn't, ask them, right? Sometimes it's just a quick email that you fire off or you have a conversation. People will be willing to give you that feedback. And so I think we just tell them the truth. And then the other thing that we try and do is point you in the right direction, right? So we had a company that was a services business. They came to us. They were looking to raise $650,000. And we ended up funding the business with $50,000, and that was the only money in, right? And so there's, we'll give people the honest answer, but I think the hope is that you push them in the right direction, right? And so that's why, as a VC, and I think you'll find this over and over again, people that invest professionally, they have these other relationships with the Ables, with the far west of the world, so that you can find that appropriate financing and also understand that fundraising isn't just one thing. You will probably have 5, 6, 7 financing solutions over time. And so it's also worth exploring some of those up front.
Thank you.
Yeah, thank you.
Does anybody else have any questions? I know there's some questions in the audience. Just raise your hand. We'll bring the mic over to you guys. Anybody? Okay, back here.
Thank you. Thank you for your presentation. I have really more of a comment that I thought might be relevant and useful. One of the angels that I was speaking with last week said that the question that he always asks when presented with an idea is, who is your competition that legitimizes your idea, and what are you doing different?
Yeah, so I think that there's two schools of thought there, and I actually think that both of them are right. So I think the best thing that ever happened to Coca-Cola was Pepsi. They split half of their marketing costs, and they educated the market, right? So I think that there's a lot of wisdom to that. Who are your competitors, and what are they doing to make your life easier? Google was the 8th, maybe, search engine, right, that really kind of had mass market appeal. So I think that there's some wisdom to that. The other thing that I would say, though, is if you're really looking for one of those moonshot businesses, it's not a zero-sum game, right? So if you think about this kind of what I would refer to as the myth of economics, right, there's no such thing as a perfectly competitive market. And if there was, we'd all be selling commodities. Right? That's what that looks like at the end of the day. And so I think it's important, but I think it also depends on the maturity of the market, right? So if you want to disrupt Coke with your Pepsi formula, great. I think that that's a great question. But think back, who was the competitor that Elon Musk was going to point to when he founded Tesla, right? He was going to have a really hard time. And so I think there's an important distinction there. And I think depending on how you ask that question or how you answer it, that might counsel you one way or another towards the type of fundraising that's appropriate to you.
Next question.
You mentioned a little bit about the whole equity crowdfunding space and microventures. I was wondering if you knew any other platforms or something similar that we could look into as a funding option, because you've been looking into that.
Yeah, so I'm going to miss a few off the top of my head, but I think when you're looking at equity crowdfunding, NextSeed is a business. So it's funny, Texas is kind of the epicenter of this. So we've got microventures here in Austin. You have NextSeed in Houston. And then there's probably about 10 or 12 others. The thing about equity crowdfunding that I would encourage you when you go out to do research is figure out how many deals actually got funded on that platform. And then the other thing to really think about is what are their fees, right? So there's a large diversity there. Those are the two, I know the microventures folks, I think that they're good, honest people, so that's why I mentioned them. Same thing with NextSeed. There's lots of other ones out there, though, and they're literally popping up every day. For the traditional crowdfunding space, Kickstarter and Indiegogo are sort of no-brainers, and there's nice playbooks out there about how to get noticed. Similarly with GoFundMe. And I think it's important to think about the flavor, right, and what you're trying to accomplish. It's an equity crowdfunding raise, go microventures or NextSeed. But if you're just trying to say, help your friend who had a blip in their business where they didn't have as much profit as they thought, maybe GoFundMe is more important.
Yeah, I had a question regarding, let's say you've got idea, and the ideas are like Uber and Lyft, right? Very, very similar. And let's say your idea you have, it's going to start in Austin. The other company has a small niche here. They start all around other cities. How do you come to an investor and say, you know what, we want to start something here in Austin and grow from here? It's very similar to the other one that they already established here. How can we be able to go forward from there?
So you're saying that there's already a local competitor?
A local competitor are not as established as they should be.
Yeah.
Very small, but you want to establish it here in Austin.
So this is, there are two kinds of businesses that I see popping up everywhere. This is one of them. So you have a local service and you're going to scale it geographically. So I think there are a lot of people that went out and had that conversation. One of my favorite examples is HomeJoy. So HomeJoy raised $65 million in 2014, and by 2015, they spent $85 million. Right? So they went out, they scaled to something like 30 cities within a course of 18 months, and they didn't have their unit economics right. And so you see those kinds of examples. So I think that's an example of somebody that had a very successful investor conversation, or a bunch of them, but didn't have the business behind it. So I think it's actually a much easier conversation to have when you say, here's my business, it's sound, now I want to scale to these other geographies. One of the things I will mention, though, is that there is a lot of skepticism about whether or not a business that's successful in Austin can be successful anywhere else. This is a weird little town, right? There's a lot of things that are going for us. We've got a lot of density in the urban core, so you've got folks like Favor that are doing really well. But can you take those models and go to other markets? I think that's the rub of the questions that you'll get is, well, sure, it works here, but why the heck would it work in Houston where everything's 3 times further apart?
Hi, question. Testing, awesome. If there's a company that's traditionally been in client services, or let's say consulting, that wants to build a more scalable online component to what they do as a way to reach a more global audience. As a VC, do you look down upon a company that has both a non-scalable component and scalable component? Would you recommend that always be a separate company, or is that okay sometimes?
That's a really great question. So first of all, you shouldn't look down on companies. And secondly, right, that's what works for all of us. And then I think the other thing, though, is there's a couple ways to think about it, right? So we have a services firm in our portfolio that always knew they were going to build product. That was their stated intention from day one. But they spent 2 years as a service business, and now they have the best customer experience team and the best client success team that you could possibly imagine, right? And so they learned a lot of valuable things. They also dialed in their processes so that when they went and committed it to code, right, they knew that it worked and that it made clients happy. Had they started the other way around, my guess is that they wouldn't have been so successful because it was a really complex business. I think the issue and the thing that scares people off there is whether or not maybe you raised money already as a services firm, and you have a bunch of investors that want that company to look that way, and now you're asking a new group of investors to make it look a different way. And so that could counsel towards separation, but that learning I think is super valuable, and I think is worth kind of walking into an office and saying, hey, you know what? I know everything there is to know about delivering this service. Now I'm going to build a product that's going to deliver the same value and is scalable. I think that's a really strong position.
Great talk. Thank you.
Thanks.
Are there any particular industries, technologies, service areas that Notley is particularly excited about or that you see are good areas of potential growth over the next, let's say, 5 years?
Yeah, so, I think big picture, I don't think that there's much argument that AI is going to be a very big part of our lives in the not too distant future. Now, we don't have any investments in that space. I mean, that's as highly speculative as you get, and you need a lot of people with sort of deep experience there. We get really excited about, so people talk about tech companies. Every company is going to be a tech company if they're not already in very, very short order. And so the things that I really get excited about are those businesses that have not yet become tech industry businesses, but need to be. So they're typically dominated by mom and pops. They're typically disaggregated. So we get really excited about those kinds of opportunities where, just a little bit of knowledge and a little bit of operational experience can take you a very long way, as opposed to going toe-to-toe with somebody else who's probably as smart or smarter than you are, trying to build the next AI chatbot, right? I think virtual reality is interesting. I think we'll see what the ultimate applications are, right? It might be for looking at hotels, or it might be something else entirely. So I think those are all interesting areas. The one thing that we're most excited about, though, is this distinction between impact and for-profit investment. That's going to go away. It has to go away. I think Facebook, Mark Zuckerberg just made a huge pledge, right? And so I think that there are some big companies like that. Everybody that signed the Billionaires Pledge, I think it's getting very, very hard to say with a straight face that traditional companies are not behaving more like impact investments.
What's your favorite company in the portfolio?
Oh, I can't answer that. I think, the services firm that I mentioned before was Scale Factor. I think that they're really smart about growing that way. And then I also mentioned home services business. Broomley is one of our companies that took a page out of Homejoy's playbook, and they said, hey, we're going to get the unit economics right, and we're going to provide more services for a higher order value in the home. So I think I'm pretty excited about both of those guys, and the rest of them too.
So how do you view companies that are trying to strategize by implementing ways to rely on users, something such as Favor or Uber or like Waze? You, from the financing side, how do you look that as a risk assessment?
So in terms of whether or not they'll be able to acquire those users?
Yeah.
Yeah, so I think it really depends on where you sit in the life cycle of a business. So if you're a seed stage investor, you better be great at dark arts, right? You better be able to kind of look at an opportunity and guess whether or not that's really going to work. I think for us, we live a little bit upstream from the two people and an idea for a piece of software. And so what we're really looking for is a scalable customer acquisition strategy. So what's that acquisition cost? Will that channel get you big enough? I think that's another issue, right? You look at a lot of people that do AdWords campaigns. Well, great, but if your search term only has 20,000 searches, you can't become $1 billion company. So do you have a scalable strategy? And then also, do the economics stand up? So I think that's more what we would look for than just the sort of general prognostication about whether or not it's going to be successful.
All right, guys, we have time for a couple more questions.
So you mentioned that sometimes, don't when you're speaking to an investor, don't worry about whether they're going to take your idea. So when is it appropriate to have people sign NDAs, and when is it a slap in the face to the person you're with and not advisable?
So that's a great question. So here's the problem with an NDA. Most of them read something like this. You will get information from me, and you can't use it in any other way. Well, guess how many people walk in and pitch the same darn thing over and over and over again? Practice management tools, right? It's this broad category. You have a company, it's a massage parlor, it's a lawyer's office, it's a dentist's office, right? I can't tell you how many people have targeted that market for new and better software to help those people run their businesses. So if we were to sign an NDA with somebody who is focused on the holistic wellness space and we couldn't talk to anybody else about a practice management tool, that would be crazy. It would close off all of our opportunities. And again, we're not in the business of stealing people's ideas. So in general, when you walk to an investor's office, I wouldn't ask for them to sign an NDA unless you're nervous. And if you're nervous, turn around. Right? That's not the person that you want to talk to. So I think that's sort of the rub of it. Now, when you're talking to employees or when you're talking to partners, right, if you're negotiating a business deal, then I think it is appropriate, right? Because you have this idea, you've put a lot of time and effort into it, and they're the people that can actually take your idea, right? And they can do it better or faster, or they're a bigger company that you partnered with and they're more well-resourced. So I think in those situations you would, but I don't think that that's something that you really need to worry about with the investment community.
Last question, guys.
I had a question about socially conscious businesses. Is it true that you would be even more careful about taking outside investing when you're not trying to, your main purpose isn't churning a profit, but to help society or make an impact? And as a VC, what type of profitability are you looking at for a company like that? Is that something that you're even giving more leeway? Thank you.
Sure. No. So you don't get more leeway, right? I mean, I think that, right, I have a very different opinion than other folks, but in my opinion, there's been this myth that businesses don't do good or that they do bad, and that's really why you have a couple of bad actors that I think have given us all a bad name. They're more often than not good people involved in most businesses. And so I think when you think about an impact investment, we have the same expectations for profitability. We have the same expectations for scalability. So the question, should you go seek outside investment, is really driven by A, the type of business, but I think more importantly, what is the impact you want to see on the world? Do you think that investor can get you there faster? Do you think that they can help you scale quicker? And if it's just something that you're doing to help your local community, maybe you don't need that kind of assistance. But no, I very, very firmly believe that a business should be profitable, and that the more profitable it is, and the faster it grows, and the bigger it gets, the more impact it's going to have. It's just on you to figure out whether or not that impact is going to be positive or negative. Great. Well, thanks everybody for coming. I really appreciated it.
Yep. Thanks, Matt. Awesome, man. Great job.